Well, somebody here is lying, and I think I might have a good idea of who that is. That's what we're going to be talking about on today's Stock Market Brief Show. We're going to be getting into many different topics on today's show, including the market conditions, expected moves. We're going to dive back into those futures that I know you all love, and some mega cap stocks, including Nvidia, because, well, that just reported earnings. All that and more on today's Stock Market Brief Show. If you haven't done so already, can you just give this a thumbs up for me? That's how you sponsor today's episode. And subscribe if you haven't done so already. Let's get into it. All right, ladies and gentlemen. Now, I want to start off with this slide to get your head in the right spot because we're going to be going over a lot of charts on today's episode. I'm talking quite a bit of charts, 44 charts to be exact, or somewhere around there, 44 slides. Now, what is this? This is just showing you a setup, quote unquote setup. I know you don't see my fingers there, but you have an entry, you have a stop, and you have a potential target. And I wanted to call this out because when you start a trade, your risk is here, your potential reward is here. But as the trade moves into your favor, closer and closer to the target, your risk to reward skews significantly more, where you have more reward to the downside than you do to the upside. So the risk gets greater, the reward gets smaller. I want you to think of that as we dive into gamma levels, as we talk about various things that are taking place from an intermarket perspective. All we can control in the markets is risk, okay? Where our exits are and how much our position sizing is on any given trade. Let's take a look at the 10-year yield. The 10-year yield was up today. The dollar was up today. Equities were up today. And that right there is enough to go, what's going on? Because as you can see on this chart, in fact, the S&P 500 down here, when we found our bottom here in April going into May, you can see the market rallied. And it was doing so on the back of a dollar that was falling and the back of the 10-year yield that was also coming in too. And this is very typical stuff. You can go back through history and see the times that this has happened in the past. But what we find so interesting now is that we have the S&P 500 rising, the 10-year yield rising at a rapid rate, I must say. And then also the dollar from October to where it is now. We literally, within a month and a half, went from the lows of the year to the highs of the year very, very quickly. So which one is lying? And we're going to go over some indicators to help us out. Because, I mean, it's a forever bull market. People are saying everything's so good. And it is. I mean, it's been really good. But you got to understand, as the party continues on, the longer the party, the louder the party gets, the cops are eventually going to show up. So it's our job to get our foot out of the door before them cops show up and arrest us all, because we don't want to be taken to jail. Okay, if we take a look at the Nasdaq percent of stocks above the 200-day moving average, I found this to be interesting. Okay, can you act on this chart? No, probably not. But when we do have divergences take place, which means that there's the percent of stocks above the 200-day in the Nasdaq, when there's less of them, but yet price is going up, it means that price is moving up in the Nasdaq composite, but yet the internals are weakening, and that has led to some sell-offs. Now, these the poor breath, you may call it, right? You can see leads to sell-off, leads to sell-off, leads to sell-off, but sometimes this can happen for a long time. Like, look at this explosive move here. Now, this could be because this was coming out of the pandemic. Boom, we fired off, and we just kept on falling for a year. And then guess what? In 2022, we sold off until we started seeing positive divergence and the market rallied. And even here, we saw a negative divergence. We sold off 10%. Or a little negative divergence here, we came off like 6-7%. Even over here, right now, we have a subtle divergence taking place where we have, quite a bit of stocks that were above the 200-day moving average. Now we have a lot less stocks above the 200-day moving average, but price action has continued to press higher. So that's one thing pointing out right now. Is it something that will guarantee that the market's going to come in? Obviously not, because this type of stuff can last a long time, but it is still a concern to see poor breath. Now, what I find interesting that you're probably not going to hear anybody talk about is this. And this right here is the put to call ratio. Now, this is important because it provides insight into market sentiment and potential turning points. And what I'm doing here, because see the purple line in the background, that purple line that's all, dulled out. That is the put to call ratio. What I like to do is I like to apply a 10-period moving average to smooth out the data. And when you smooth out the data, it's a lot easier to see. Now, what does this mean? Well, a high put to call ratio suggests, right, there's more puts being bought relative to calls, which typically indicates fear in the market. And traders are hedging against declines. Now, a low put to call ratio, so when it goes down, this suggests greed or excessive optimism as traders are betting on rising prices. And this can be a good contrarian indicator, right? So we're getting a low reading here on the 10-period moving average, which can suggest, bullishness, which it is, but it can be a contra indicator. And I want to call out this little red line here down at 0.8. We're at 0.82 right now, but the last time that we were this low and we crossed down through 0.8 and back up through it, that led into the 2022 bear market. Not to say that the same thing is going to happen, right? Not at all, because we can go back through history and look at this multiple times, which we'll do on another episode. And it was when the market was going up, but we did see weakness when this line rose. But what I find interesting here is if we zoom in and we take a look at where we are right now, this is lower than it was here. It was lower than it was here. And as we were getting these big rallies and this was coming in, getting a big rally and this was coming in, it happened to be where we started turning back around in the put to call ratio, and we went through a 9% to 10% decline and a minus 6.6 decline. So right now, what I'm trying to point out about who is lying in the market, it could very well be equities. So we got to be very careful. Now, I want to preface this with, as we started with the risk to reward, it does not mean that we can't go down here and the market can't go up higher. That's not what I'm saying. But perhaps if we do continue to go down more, or if we don't, and it starts turning back around up through this area, it could be a point to say, hey, pump your brakes. As I'm talking about more breadth indicators, you can look at the Nasdaq MLAN Oscillator. And as the market's been pressing higher, this has been rigging a negative number here under 0, which is not always the greatest sign. The Nasdaq summation index also is on a sell signal, but this has been very, very whipsaw. So it's been less reliable in recent trade, but it has marked great turning points in the market in recent trades prior to 2024 and even within 2024. Now, with all that said, Bitcoin is, through the roof right now, almost nearing 100K. It couldn't very well be there while I'm talking. And you can see that here, the sailor to shift tool was on a buy signal, is on a buy signal still currently, boom. And we're right at around those levels. If we pull up the chart, what a massive, massive breakout. It definitely looks like it's going to be hitting 100K. Is it going to be doing it within the next day or so? I mean, it sure seems like it will. And as this is all going on, geopolitical tensions, they are continuing to rise too, but it's not being really shown in the market. So is the market just being negligent about what's going on, or does it know something that's bigger taking place? Well, I don't really know the answer to that, but I can guarantee you this, we're going to find out. Crude oil was up slightly on the day, and it is in this compression pattern here, looking for a break in either direction. It is in a bearish trend, seeing lower highs, but it is in a compression pattern, and we should be aware that the price momentum oscillator, even the RSI, as this was kind of matching lows, we do have a higher read print here. So if energy wants to go higher, that could actually be bad on the S&P 500. We talked about this an episode or two ago, and we talked about some of the individual names within energy sector that you might want to pay attention to. We talked about NOG. NOG broke out today of this little contraction pattern, and we talked about, I think, XOM as well, which it saw some strength today. Now, TLT, which I find interesting here, would be more of the safe haven run to, but yet that is also underneath the quarter to date expected move, and it's pretty much at lows for the year. On the flip side to that, we do see this little compression pattern taking place here, or a diamond pattern, and sometimes these diamond patterns can mark reversal points. So if we start getting back above 91, are we going to start to see TLT get a little steam again? As we've matched these lows, the price momentum oscillator is starting to flatten out to turn back up, and even RSI has a positive divergence too as well. You got to be cautious going into stuff like this, given the fact that many people are short, but you want to just be cautious and really wait for the right entries and make sure you're managing risk. For example, if you were to play through 91, your stop could be probably right through here, right? And you could build out your risk unit from this kind of level. And then perhaps you take profits up here, which would be a 1-for-1. And who knows, maybe if it goes a 2-for-1. That'd be one idea of a very quick example. This is also happening on the back of our yield curves are starting to invert. This is the 30-year 3-month, that uninverted. The 20-year 3-month uninverted. The one that has not is the Fed staple, the 10-year 3-month, and that is sitting right at about negative 10 basis points. But you can see it's been steepening. We're just not there yet. Okay, so this is going to be another one. As we've inverted, when we had all of these three inverted, it's only been a few times throughout history. And you can see in 2001, when we started uninverting, we led to, obviously, the dot-com bust. And then over here in 2007, that was the great financial crisis. Are we going to have a same outcome? Probably not. But can we still see market volatility or something new to happen? And will we look back at this in hindsight? That's a possibility. But how do we navigate all of this? Because what I've said so far is rather bearish, but yet the market conditions, which we're getting into now, are rather bullish. Let's take a look at the very short-term 5-day moving average. And this was all red the other day, okay? And it could change quick. And guess what? We're starting to see green on our screen, and we like green on the screen. Well, if you're long. So the 5-day moving average is starting to flatten out now, right? We said it'd be about a couple of days. Well, there you go. There's your couple of days. It's starting to flatten out. Price is above it. And now we see if it can hold the green, and we can see that change in trend take place. The Qs are yellow, which means that it's still declining, but price is above it. So if we stay above here, even if we come in, this can flatten out more. It could start to turn green and potentially turn up. IWM is green. Dow Jones Industrial Average, green. We got semiconductors, yellow, and XBI, which is biotech, also yellow. So we're starting to see green shoots, which is a positive sign. Now, when we look at gamma, the gamma flip line is roughly at 5,900. And guess what? We're in positive gamma too. So this is typically where volatility comes in, right? Volatility reduces, and this is where dealers look to buy the dip and sell the rip. Now, when I talked at the very beginning of this episode, I mentioned how the risk and reward changes as price moves to a target. Listen closely. This right here is a chart of net gamma. And as you can see, we have this gigantic level at 6,000. In fact, we came into around 6,000 prior, and we said, be cautious when we're above it because we can whipsaw back and forth and potentially break lower and then come back in. And as you can see here, we are right there, right about that 6,000 target. Now, it doesn't mean that we can't break through this and go higher and traders start to reach out to say 6,100. But as it stands in this current moment, it's going to be hard to break 6,000 when it's such a large strike in this current context. And to mention on top of that, we have that JPM, right? That JPM collar, which is roughly at about 60.22 as well, which can limit the upside or cap the upside in the market until the end of the quarter when they start their new position, their new collar. So that's why I wanted to mention how the reward is kind of getting minimum up here, has the potential to be bigger, but right now, it's minimum, where the downside risk down to and around back to that 58.50 level, which we've came into, right? We came back into it. We almost came back into it. We even saw some sell side today to 5,900. Okay, we've been dropping, and then the bulls stepped back up. So it's positive, but we just need to be aware about where price currently sits relative to these targets. Let's get into expected moves to, once again, talk about risk versus reward. Our expected move was $9.83 in the SPY this week. You can see we closed this week here, and we basically traded for 3 days, tagging unchanged on the week. But when we got down there, the bulls, they wanted to step back up. We came back down there today, but they stepped back up. And take a look here. We're right there, a stone's throw away. We actually came basically into it within pennies, right, to the upper weekly expected move. And if I zoom in on the weekly time frame here, you can see we were just about there, and we started to kind of decline. Now, going into tomorrow, we have a daily implied move up there at around 598. I'm going to round it down, and then 600. Sorry, round up and then round up. 600. And then below us is about 589.50, 587.36. These are incredibly important, especially if you're intraday trading. Now, since we're here roughly at the upper weekly expected move, if we gap up through this tomorrow, that would be a pretty positive sign. I'd say start watching into this zone. If we get up into this area, that is by the upper monthly expected move, which we were there and we talked about when we got there, how that can also cap upside. And well, it did cap the upside. So the reward for going long now is not as good. So what would be better? A better situation would be if price were to come in, say back to the week to date anchored volume weighted average price, back to the daily implied move, and back to a 5-day moving average where it's flattening out. Then you want to see price put in a higher low and potentially see strength through that to come back into the weekly and potentially even head higher through the course of time going into the next week, next month, possibly. That's okay, right? We don't know what's going to happen, but we can only talk about possibilities or probabilities of what may happen. If you like these daily expected moves, if you want them for the Qs for IWM, if you want them for the futures too as well, I post them, one of the many benefits in this swing trading Discord. Sorry, it's not a Discord, it's Patreon, and then you sync your Discord up, but I post everything on Discord. But that's not all I do. I do obviously daily, weekly, monthly, quarterly expected moves, but I also give my watch list, tight list. I give trade ideas. For example, the most recent one was actually in IWM. This is ready, but we'll get into the futures here in a moment. But I wanted to just plug this because I almost never talk about it. It's only $9 a month, people. This is one way that you can support the channel and then also get, I try to over deliver that $9. So you can just ask the community, ask in the comments, see what people say about it. Well, that's totally fine. It's not an alert service. Okay. So don't come in thinking that it is. We're going to talk about futures now. So we talked about futures not too long ago, just the other video. And we talked about how we pulled into this golden zone over here and we had a bullish outside day. We're getting some of that follow through. Okay. So are we putting that higher low and are we going to go for the higher high? I think that's a possibility as long as market conditions remain above a 5-day moving average that's rising and in positive gamma territory. So even though we talked about bearish things, in the very short term, there's still a bullish scenario here. So what I want to see is us hold this low from this prior date that was mentioned on a prior episode. If you take a look at NQ, we talked about being up here can potentially see where we saw prior support and we thrusted through that, where we saw prior resistance and we thrusted through that. This zone up in here can act as potential resistance. And you can see we almost came into that today. So if we do start to kind of climb in there, that could be a level of potential resistance to watch out for. Overall, though, we're still holding above this low. We came down again, but the bulls are pressing higher lows right now. So if we start to see this change where we break this low, just be a little bit more cautious given that context. If we take a look at Ready, right? Broke out. We pulled into the golden zone, kind of undercut it a little bit with a nice hammer candle. And we're seeing some follow through today. And this showed much more relative strength than the other index products as it was up more on the trading session. Then we have YM. Also, another really nice setup here, how it pulled into that golden zone, right? That 50%, 61.8% retracement level left us a hammer candle and an inside day. And we basically said, if we start breaking through the high here, look for a potential retest of the highs or back into and around these levels. And we darn near almost got there. So we'll see if we can get some more follow through going into tomorrow's trading session. Now let's get into the mega caps because, well, Nvidia reported earnings last night. And, well, guess what? What did it do? It did nothing. It did absolutely nothing. It was like Google reported earnings, but Google just had news about something to do with Chrome. So let's hop into Nvidia. We had a $12.97 expected move. It didn't get anywhere close to it, right? And the weekly expected move is yet been tagged. So let me update you here and let's see what it looks like. Well, we're rather unchanged. We saw a nice wide candle, which given the context, we did see a lot of volatility. But overall, I don't mind seeing this actually. Honestly, it's a bullish consolidation with a wide open weekly expected move. So the thing that can really get this market moving tomorrow could very well be Nvidia playing into still an upper or a lower weekly expected move. So what I'd like to see is where Nvidia opened up. I'd want to see price start to break through that. Personally, I'd like to see it tighten up and then break through because right here you have a pretty clear pivot line that if we start breaking up, right? This could just be one of those higher lows. Then we have that higher high that's currently forming. So I'd be looking up into this range if Nvidia wants to continue. But just be aware, if it starts breaking down further, I mean, it can drop down to 128. And that you shouldn't even be surprised, to be quite honest, if it came to 128, because that would still be within the implied weekly expected move. So just be aware there on Nvidia. Now, Google, whoa. Google cut through that 50-day moving average right into the 200-day moving average and started finding some support down there. And you can see intraday, this is the weekly expected move. We started cutting through that a little bit, and then we started finding our way back into the weekly expected move and closing slightly back within it. So it's good to know where these levels are, because when we started cutting through this, I posted it on Twitter. And when we got to the 200-day, I posted it again there on the swing trading community, because I know that this opens up opportunities. I took a trade in Google back into these weekly expected moves a little bit beforehand from lower levels. I can't really remember exactly where, but it was a profitable trade, and I wouldn't have taken it if I didn't know exactly, what this level was and why it could be potentially very important here after a very, strong move to the downside. It would create a lot of fear, but if you know where the levels are, you have a good sense of what can potentially take place. As far as probability goes, Amazon also got clipped a little bit, but it is still in rather a pretty strong, breakout formation. So we see this breakout now. We see price consolidating a bit. We had an inside trading day and we cracked and closed through the low. So just be cautious of this. See where it kind of ends up. Maybe it wants to come to the 50-day moving average, and even if it does get down there, that would still be kind of just really just back testing a prior breakout area. So it still would be pretty bullish context. So just be aware of that. But we'll see how this shapes up here in the near future. Overall, it's still a pretty good looking chart, but we may see some near-term volatility. And I'll show you what that looks like on the 5-day moving average. Now, Microsoft, on the other hand, this is looking a little sketchy. So Microsoft is one of the largest market cap names in the market, so it holds a lot of weight. And if Microsoft breaks down from these levels, it could bring some other things down with it, and we got to be very, very aware of that. Now, why do I say that? Because we'll look at the 50-day, the 20-day, and the 200-day. They're getting very tight. They've been very tight, and we're starting to see very, some chop around it. But what do we notice? We see lower highs being formed right here. And what else do we see? Well, we see higher lows. Actually, this was a lower low right over here. Okay, and then we're currently standing right here. So price is compressing, it's contracting. We see lower lows. Sorry, we saw one lower low, but pretty much higher lows right here. And we're below all these key moving averages. And the longer we stay down here, the 50-day will start moving more down through the 200, the 20-day, and then the 200 will flatten out to potentially turn over. And that would not be a good sign, because it could be marking a change in trend in the markets, which could result in Microsoft taking a larger hit. And if Microsoft takes a larger hit, it could very well potentially bring down other players related to it in the market. So just be aware that this current setup, right, if it doesn't resolve itself quickly back up to the upside, it could be not a good look for this big cap stock. And then Apple too. Apple is seeing higher lows into this main pivot area up here, and it's a bullish formation. But in the very near term here, it's kind of flagging out, getting pretty tight after a pretty solid move to the downside. So I would just be very, very cautious, as these last 4 days have been rather tight. 4 or 5 trading days have been tight. If it were to break down, that can also be a near-term potential bad sign. As the 50 days flattening out, the 200 goes down. It could open the door a lot lower in Apple, which could also be pretty bad for the markets. So what I'd like to see here, if you're bullish the markets, you'd want to see Apple start to break back up and retest these highs up here, potentially tighten up more for a end-of-year pop or rally, so to speak, for this big mega cap name. Tesla has been very bullish. It's got pretty extended, but these last 4 trading days, just be aware, it's getting very tight and volume is drying up. And when this happens, people, we start to get explosive moves in the very near future. So as volume dried up, the lowest that we've seen it since pretty much this last flag pattern over here, and then boom, we exploded. Watch for some breaks start to take place. Perhaps through 350 might open the door to retest these highs and potentially higher. If it cracks down, we'll start looking for a gap fill and potentially come back into a rising 20-day moving average. Take a look at Meta. Meta had an outside trading bar today. Still within this larger megaphone pattern as we've been putting in lower lows, but we've also tested this pivot level multiple times. And the more we test these type of levels like this, the more likely it is to break out when we do get back there, if we can get back there. But this is a nice hammer candle. We're above a rising 200-day. We're below a rising 50-day. So the trend here is still pretty good. Yeah, the 20-day is flattening out to slightly declining. But if we do start to recoup these levels in Meta, it opens the door to retest that 600 level. Now I want to stop over here. This will be the last slide. This is the 5-day moving average of these mega cap stocks, XSPY over here. But we have Microsoft that's below a declining 5-day moving average. So if you're bullish Microsoft, but you haven't put a position on, maybe you want to be more patient and wait for price to maybe gap over and this thing to start flattening out to turn back up and set back up itself. But right now, it's under a declining 5-day moving average. Apple, it's above a rising 5-day. Amazon, below a declining 5-day moving average. So if you're bullish Amazon, perhaps you might want to wait to see how this one sets up in the near future. Tesla, it is above a rising 5-day moving average. And like we already previously stated, it's contracting. So this leads to me to believe that it can be more into the bullish nature of a move. But we still need to manage risk because it doesn't matter if we're right or wrong. What matters is, when we're wrong, are we getting out of the position and are we only losing a certain amount of risk? And when we're right, are we letting our trade play out to our potential targets and managing risk along the way? That's what matters. Okay, predicting, it doesn't matter. Nvidia above a 5-day moving average. It's rather flat, but it is starting to turn back up. Google below a declining 5-day moving average by quite a bit, and it could be kind of extended as we're back down to the lower weekly expected move. Meta, it's starting to turn yellow. So hey, perhaps this hammer candle, even if we pull back down to around 557.50, perhaps it starts to flatten out to turn back up in the near future. So you'd want to watch to see how that shapes up there in Meta. And then we already talked about SPY. That's all I got for you on today's episode, everybody. We went through a lot. Hope it helps out. See you later.